Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors, and today on Geared for Growth, I'm joined by Patrick Noll from Runestone Finance. Now, Patrick is a eastern suburbs Sydney-based mortgage broker who has carved out a very specific niche, working almost exclusively with property investors, but particularly high-income professionals in their 20s and 30s who are grappling with affordability in cities like Sydney. We unpack why even people earning well in the top 1 to 3% are struggling to justify buying where they live, why rentvesting has become a rational strategy rather than a compromise, and how lending structure, automated valuations, and market selection can materially change outcomes over time. If you've ever looked at $1 million plus apartment and thought, surely there has to be a better way, this conversation is going to challenge how you think about borrowing, investing, and long-term strategy. Let's get into it. Patrick Noll, thanks for joining me on Geared for Growth.
Thanks for having me, Mike.
First time on the show, and we had a really good chat last year, and I was very, very excited to introduce you to my audience that may not have heard about you. But give us your elevator pitch. Who are you and what do you do, Patrick?
Mate, I'm a mortgage broker, first and foremost, and been doing that for about 8 years. Initially sort of wore all hats and did a lot of owner-occupier and self-managed super fund and investor loans, and then started my own business, Runestone Finance, about 5 years ago. And now we're sort of about 90% of our client base are property investors. And that's probably been because I've sort of skewed towards that in my personal investing life as well. I live in Bondi. It's chronically unaffordable here, naturally, as I'm sure everyone knows. So, no matter how well you're doing, and we do have some clients who, are doing incredibly well, earning sort of $250,000 a year at 25 in banking and things like that, and yet can't hold a candle to a unit in the areas they grew up in the eastern suburbs and North Shore. So we sort of started looking for another way and fell on sort of rentvesting and sort of the pros of going down that route. And as I sort of built my portfolio, so too I sort of spoke about it on LinkedIn and naturally, as you do, built a client base of like-minded 20s and 30s who are facing those same affordability issues in Sydney mostly, but some other areas as well. And so we're now the broker for investors.
Awesome. And there's lots to unpack, and we are going to answer some of the big questions that people might be thinking, oh, great, he's trapped a mortgage broker. I want to know how I maximize my serviceability, or what's all this about trust? I mean, we've done plenty of episodes on trust, so we might park that one. But I want to touch on the first point, and that is the fact that you've got people in their 20s that have really kind of won the lottery in terms of their ability to get a job for $250K, way above the average, but they're not uncommon in the eastern suburbs. And it sort of takes a salary like that to even rent a place in the eastern suburbs. But run us through that scenario. Like, what sort of price point would we need to pay for a unit for a young professional compared to what they might be paying in rent per week? Just starting with that point.
Yeah, I think it's been a big talking point, particularly after October 1 in 2025. We had those sort of thresholds for the 5% deposit scheme move up to sort of accommodate higher price points. And we can talk and debate what that did to the market. I think, I speak to a lot of buyers agents on the ground in areas where perhaps that suburb wasn't under that price cap and then it was, there was, growth of $50,000, $100,000 overnight in some of those areas. Yeah. It was just crazy. And yet, you hear, I think the Treasury's initial estimates were 0.6% over 5 years was their anticipated impact on the housing market, which a little off, I think, is safe to say.
Thanks for playing Treasury, but you absolutely biffed that one.
Yeah, thanks for your input, but not quite what we're seeing on the ground. Nevertheless, so in Sydney, sort of getting up to 1.5 mil, it did tick the box of, getting up into an area where you can buy sort of a 2-bedroom apartment in one of these more blue chip suburbs. You can still get a 2-bedroom apartment, maybe in, the North Shore, Neutral Bay, Bondi Junction, some of these areas where these high earning young professionals live. Now it was sort of on the cards. Where it missed the mark is, of course, you do have to also account for the income that it takes to borrow 95%. So if you look at a $1.5 million purchase, for instance, yes, you now only need to put in 140,000, right? Being your 5% and your stamp duty, and that's great. That's a big win for a lot of people, not having to save a 20% deposit, which is fair enough. The issue comes in now you've got a $1.425 million loan, right? Being 95% of 1.5 million. Now, if you're single and you want to borrow that amount of money, assuming you've got no HEX debt, no other debts, no car loans, no credit cards, nothing, you're just a, very sort of vanilla single, we call it, your income is going to be $285,000 a year plus super.
Wow.
Which, look, there are people who are on that, not many, because that would put you in sort of around the top 2 to 3% of earners in Australia, let alone people who are 20s and 30s, of course, who is sort of usually much lower than that. So you're probably in the the top 1% at that level.
And that's not necessarily to live a grand existence as a mortgage holder of an apartment, right? That's where the bank is kind of saying, this is right where we start getting nervous of actually giving you the money. So it might not necessarily be 2-minute noodles times, but that's throwing the kitchen sink of your income at the mortgage, right?
Absolutely. Yeah, absolutely. And look, we all know that banks use additional metrics to determine whether or not you can service a loan, right? There's a 3% buffer with the regular banks on top. So it's not that that person couldn't afford the repayments, by the way, which are $8,100 per month. That would be the repayment on that facility. And the way that amortization schedules go over 30 years is those first few years, you're paying mostly interest, right, out of your monthly repayment. So out of that sort of 8,100, about $6,500 of that is interest, right? So it works out to be about $1,500 a week worth of interest. Now, the great part is, which is why Rentvesting tends to make so much sense, is that instead of paying the bank $1,500 a week worth of non-tax deductible interest, you can actually go and rent that place for probably $850, $900 a week rent. So the disparity between the opportunity cost of renting and not became very much weighted towards renting being a better option. Particularly when you then add on maintenance, water, council rates, body corporate fees, which a lot of these areas often come with higher body corporate fees as well. Loosely, you'd expect to be paying more than double in sunk costs on a monthly basis than you would if you rented the same unit. So yeah, that was the first thing where people are going, why would I do this? This is something that doesn't make a whole lot of sense. And then from that, obviously, is begged the question, well, what else can we do? Because if you compare that scenario to doing nothing and just putting your money in a savings account and letting it be sort of taxed by inflation, well, you'd probably be better off buying, right? If you buy a good asset and maybe add some value to it, you don't pay capital gains tax on that owner-occupied property as well. But if you compare it to what you could do as that sort of earner, buying investment properties and getting 2 or 3 at sort of $600,000 to $700,000 on the investment side, the negative gearing benefit as well, and being able to rent exactly where you want to and not a little bit out, perhaps. It tends to be skewed towards that being the best option for a lot of people.
That's the thing, isn't it? Because it's one thing to sort of say, well, I'm not sure if I want to stay, let's say, in Bondi, but for people that are like, yeah, I grew up here, I'm gonna die here, I'm all in on Bondi, so I guess I'll buy something. But when you look at those numbers, it doesn't actually stack up on paper as making sense. What you can do with that leveraged money elsewhere and de-risk it instead of putting all your eggs in one basket. And then, of course, no one likes paying rent to somebody else, but I'm sure you've got some juicy numbers or some case studies to share with of people that were in that situation and thought it is mad to buy.
Yes, 100%. Well, look, I think I had a lot of those conversations as 5 years ago when it was starting up the brokerage, and then it was a very similar case study to the one I just outlined for myself and my fiance. We were doing the same numbers and thinking, do we downsize effectively? We don't own here in Bondi, we rent, but do we downsize where we live and live somewhere where we don't really want to be, in a worse location, in a worse unit, without parking? Do we go down that route and then have the big mortgage versus why don't we stay here and then learn as much as we can about property investing. And your podcast has been brilliant for that, and others like it. So thanks very much for your content over the years.
Thank you kindly.
And that's all right. No, it's been brilliant. And also then, doing as many courses as we can do, and sort of, doing our best to educate ourselves on how property works and how to sort of spot those markets. And then luckily enough in my, as a mortgage broker, I've lots of connections with brilliant buyers agents, many of which who've been on the show. So being able to have the extension of being helped by those guys, and then taking the plunge and buying something, the first time you don't have a clue how it's going to go. You hear people having success, but it's one thing to hear about it, another thing to experience yourself. And then naturally getting that sort of, for all of our clients, we do annual reviews. And what that means is renegotiating your interest rate. But more importantly these days is getting a suite of automated valuations, and seeing, well, how is the property actually going? What does the bank value it at? And is there any equity there to go again? And that mechanism of the extraction of equity to use for the next property, that's what these high income individuals are really benefiting from, because they don't need to keep saving every time they want to go and buy another property. Their income is getting much higher and compounding over time in these really 1%er roles, but they don't necessarily want to have to save a couple $100,000 every time they want to buy a property.
Yeah, and I suppose if they're picking the right markets, they won't have to. And with your example, $1.5 million apartment in Bondi, for example, it is reasonable to think that you could be getting 3 properties around the country. I mean, Sydney did do 5.8% growth in 2025, but compare that to Brisbane that did 14.5. Sorry, that was 18.3. It did. No, actually, it was 14.5, pardon me. Adelaide, 8.8, Perth, 15.9, and Darwin, 18.9. Now, maybe Darwin's outside your risk profile, but there's plenty of other places where you really leverage that into other assets. It's not just the negative gearing and all the tax deductible bits and bobs, but it's actually the return of that particular market as well. On top of the fact that in your own example, do we want to live somewhere not as good a location, smaller, but it's ours, so that's something.
Well, it is something, and it's something for my fiance as well. Is very hell bent on this, and this is, a conversation that I have with clients up front as well. It's not the right fit for everyone to do the Rentvesting thing, right? And I think ultimately in that first conversation we have when we do our strategy meeting, it's very much a case of, well, what do you want firstly? And if somebody says, well, I actually do want to live a little bit further out, and that does fit within the parameters of where we can buy without needing a massive mortgage, and that's right for us. It's big enough for the kids. It's in the right school catchment, and we don't need a massive mortgage. Well, great, let's go and do that. One of the biggest tax breaks in Australia is the capital gains tax waiver for your principal place of residence. So True. If you can buy where you want to live and fits for you, brilliant, do that. That's always the best way to go about doing it. But don't buy somewhere where you don't necessarily see yourself long-term and really want to live, and take out a massive mortgage just because you feel like you have to. There is another way.
Yeah, and that's a really good point to make, I think, because, people like me in my, let's just say I'm in an ivory tower right now, would sort of say, oh, why would you do this? Because the numbers just don't stack. It's a silly decision. But the numbers come second to, like, you actually are living a life. You are not just a line on a spreadsheet. You're a human being with wants and needs and those sorts of things. But I think that's just the conversation that you need to have with a specialist, with your partner, your husband, wife, whatever. But, you can't expect, one thing to do everything. So if you really want to live in a particular property, then you might be sacrificing on your potential return elsewhere. But that doesn't mean it's the wrong decision, right?
Ultimately, we all care about return, but not as much as you care about, the life you want to live. I think that needs to come first and foremost. And so for us, would I just Rentvest forever? Yes, I would love to do that. I love being able to sort of, the moving part is great for me. You pay more to hire movers. It's a fraction of the cost of actually having to buy anywhere. You make it as easy as you can, and you do get to move around. Now, that's spoken from a man who doesn't have kids. And I acknowledge that probably will change in the next couple of years. But my fiance is very much, she wants to own where she lives. So our compromise is to do the rent vesting thing until, for another sort of 10 years thereabouts. And then at that point have built up a hopefully large portfolio of investment assets, and then sell all, some, whatever amount down, and then go buy the owner occupied property, but not need to have this terrible sort of restrictive, massive mortgage.
Yes.
And that sort of sell down process is, probably not as efficient as it could be. You're going to pay a lot of tax and what have you. But if it ticks the boxes for you long term, it can be a really great strategy.
Yeah, and like your hell bent sort of sticking with rent vesting is probably not worth being single for example. These are all things you need to weigh up.
Yes, 100%. It's the very first thing that you've got to weigh up. That's right. Yeah.
Now that we've talked about that, and I suppose we're not just talking about eastern suburbs of Sydney. I mean, it's applicable for anyone that wants to live close to the action, and there are equivalents in Melbourne and Brisbane and Adelaide. So it's interesting insights that these high, people in the top 1, 2, 3% of income earners are at the point where, like, gee, we can barely afford to do this, or even if we can, it might not be a good idea. So let's focus more on the investing side of things. Obviously, that's the strategy that you're leaning into and the majority of your customers. You talked about automated vals and have a point to make about them actually being part of the strategy. I remember chatting to you last year where I had a property that was an automated val darling for some reason. It always came up more than what I would likely sell it for. I knew that there were issues with it, but when the banks did their thing, I was like, maybe this is the game. Like, just find properties that somehow tickle that algorithm and there's something in it. How much does that automated val option sort of weigh into strategy from your perspective, and what percentage of banks are doing automated vals rather than an in-person one? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Look, most of them is the short answer on that last part of the question. Most are doing automated valuations. It used to be they'd farm it out to external valuers for $300 or $400 a pop that the bank would pay for in most instances. So very powerful for the banks to be able to not have that upfront cost and do an automated valuation system, right? It's instant and they can win business on it. And that's really what we've been seeing, for better or for worse, over the last couple of years. Is it seems that banks have realized that a way that they can attract additional business is actually, rather than impacting their bottom line and lowering their rates to bring more in the door that month, which is traditionally how they did it, now they can actually sort of turn the dial on the automated valuation tool. And that might not be across all of Australia. It might be in a market that they think is going to be, a little bit safer than another, or is growing really well, or the fundamentals look good for. Again, I'm not going to pretend that I know exactly how it goes on in the background. However, as somebody who runs a company, we do, I don't know how many 30, 40 valuations a week over the last few years, and these automated valuations with multiple different banks. Some of the discrepancies are just outrageous. I mean, you can have a valuation on one property at $1 million and another at 800,000 for the same property. And does that mean that the property is worth $1 million? No. And so we've seen this sort of, particularly on LinkedIn, you see a lot of people talking about, oh, well, I got this property $50,000 under value because the bank says it was worth $950 and I got it for $900. Does it mean that it's worth that? Well, no, it doesn't, right? It's got no bearing on the actual value. However, if we're talking about getting you to the next asset and allowing you to scale the portfolio, it does have very real tangible value because you can borrow against the value of that property. So, and the way that the bank sort of scrape data to formulate what their valuation is, of course, it goes off comparable sales that go through online. But it seems, and you spoke about sort of your your darling of AVM's property that you were talking about. I've got one of those as well, actually, and so do a lot of our clients. Now, it seems to me, and this is sort of my guess, having just done a lot of these, that if you're below the median house price in that suburb, and it's an older house, but on a larger block and a larger build size and good specs, right? So if you're talking about a 422, if it's a new 422, well, the stuff that makes it new and that you can depreciate on, for instance, that's the stuff that makes the value go up in terms of when you're doing a purchase price. But it's the older ones that are still big and sturdy, and you're not paying for the upgrades. Those are the ones that the bank goes, well, this one might be brand spanking new, and this one might be 20 years old, but they've got the same specs, the same land size, the same build size. It might say this one's a bit higher, but this one might have been 30% more on the purchase price than this one, right? So it's those sort of discrepancies that now with the data we have access to, you can go and look at that, and you can do, and a lot of our investor clients say, hey, I'm looking at this property. Can you do an AVM on it and just let me know what the bank thinks it is? Now, I'm very careful talking to clients, Mike, to not say, go and buy it for $1 million because, X bank says it's worth that. It doesn't mean that it's worth that. You need to do your own, comparative market analysis and decide what it's worth for you. But what it does mean is if you can find a good property, buy it well, but also there's a discrepancy between automated valuations and what you're buying it for, it means if you're ready to go again in 3 or 4 months, we can pull equity out very, very quickly. And that could be the difference between you buying in 2 years or buying within 6 months, which can really scale up over a lot of properties very quickly.
I was going to ask you that question. What is the minimum time that a bank would be happy to go back and do an AVM? And you were also sort of talking about, the data point of comparable sales. Let's say the AVM says $1 million, we buy it for 800 and we wait 6 months because we're like, whoa, I want that 200K, or maybe it's even more. Does that 800K sale actually create a new data point for that job, which will actually impact that AVM when we go and run it again?
It does. Yeah, it does. So they move around, daily, really. Every time it's got more data to pull from, it does move around. So it's very much a case of you give it a crack when you can, And so the way that we've sort of running a business, you can't exactly do a valuation every week on all of your clients' properties, or it wouldn't be a very a good business model. So what we do is when we have that initial strategy meeting and a new investor comes on, firstly, whatever their portfolio is, we start with a suite of valuations on everything. But moving forward, it's a case of, hey, Mike, what do you want to do here? Do you want to go and get 3 or 4 properties? What's your timeline? What's your end goal? And if the answer is yes, I want to buy 3 this year, well, then we're going to put checkpoints in after the first purchase. Maybe it's a month afterwards. Okay, let's get updated valuations and see what we can do to extract equity if it's required from a capital perspective, and sort of put those junctions in throughout the year to get you to whatever that end goal is at the end of the year. So it's horses for courses. Some people say, I want to buy one for now. Most people, it's one for now. We'll see how we go. Let's chat in 12 months, right? So that's the strategy for most people. Depends how gung-ho you are.
Yeah. Now, we've sort of prefaced a couple of things in the beginning of the conversation. One was trust. The other is, what has this broker guy got to tell me? Where's the secret sauce? Who are the third tier lenders that are going to let me borrow when the big 4 are telling me to get lost because I'm leveraged to the eyeballs? Everyone wants those shortcuts, but what is there out there that you're kind of seeing people lean into and actually achieving results on?
Yeah, I think the trust thing has been beat to death almost at this stage. And so, just to sort of very briefly touch on that, it was a case of being able to extend your borrowing capacity by sort of not needing to declare certain debts if they weren't borrowed in your personal name. Essentially, that was the nuts and bolts of it. In the last 3 or 4 months, most banks have come out and said, okay, we acknowledge this has been an issue. People are talking about it on TikTok. It's probably time to patch it up. And so many have exited that space. there are still some third tier lenders. Even some of the third tiers are now starting to exit that space. But ultimately, there's always little things that are available. Like the automated valuation. Will that be gone next? Who knows? People are certainly taking advantage of it in some capacity. There's always going to be the secret sauce that's going to be out there, right? And I think as an investor, it's just important to have a really good team around you, and that involves, of course, a buyer's agent, an accountant, a good lawyer, a good mortgage broker. You need to have a team around you that knows when these things pop up, because the reality is they do pop up, they are exploitable, and they can be in your best interest. And as long as you've got a trusting team that's not farming you out for money. On that note, I'd have loads of people come up to me, Marcus, I'm sure you can appreciate it, over the last couple of years and say, I've heard about this unlimited borrowing capacity thing. I'm earning 75 grand a year and my wife's on 55, and, we want to get our fourth and fifth property in trust so we can buy our sixth. And, the answer is no, of course, because at the end of the day, brokers are bound by best interest duty. And what that really means is, just because I can get you the money doesn't mean that it's the right thing for you. And what that means is you have to break down, well, how much do you have after you pay tax, after you pay the school fees, after you pay your living costs and your mortgage? What have you got left? And if the answer is not much, well, you can't buy another property, can you? Even if the bank would give you the money. You're essentially taking off the protective layer of a bank saying, we're only going to give you as much as you can afford. For most people, that's great. If I can't get it, I can't get it. But if you remove that part, well, then the onus is on you as an individual. So yeah, that's been an interesting sort of shift in the market. As far as what the secret sauce is today, it very much just comes down to structuring and doing it in such a way that actually fits your goals. And that's both on the lender side and also on where you're buying. If you're sort of lower income and your affordability is really tight, but you want to get into a certain area, maybe you're more focused on yield. If you're very high income and you can afford to go really hard at capital growth and yield's not really a big issue, maybe you get into a hotter market with a worse yield and just go after capital growth. So working with a really good buyer's agent, you're going to understand all of those things and they're going to be tailored to you. And so where you go is not necessarily where you should hear about going suburb-wise on a podcast or on a LinkedIn post, because that's probably a strategy for somebody else. It needs to be tailored to you in order for you to, achieve your personal individual goals. And that sort of applies to the lending side of it as well. Loosely, the way that we sort of structure things is you go and exhaust your borrowing capacity, if that's your goal, with the big banks, right? And they're sort of typically cheaper, more conservative, but you're going to be able to, get the best interest rate at that stage and the best policy for you. Now, after that, if you do want to go again, as some sort of ambitious, high-earning individuals do, you can then use third-tier lenders to get more money, right? And you don't have to sort of necessarily use trusts at all. You can do that in your individual name if you want to. And third-tier lenders, essentially, to keep it simple, they charge you a bit more on the interest rate and they inherently take on more risk and give you more money. That's the nuts and bolts of it, to drill it down. So for some people, it might be the difference between buying one more now or having to wait a year before a big bank will give you the money. Now, if you're buying in a market that's, doing 10%, it's probably 600K, you're making 60 grand in the meantime. Yes, you might pay an extra $3,000 worth of interest, but I don't think you'd care if you've bought well. So that's the extra sort of piece of the puzzle you can clue into on as well.
That's the big if, isn't it? I mean, if it is a market that is going to do 10 or 15% within reason, it sort of doesn't matter what the interest rate is. But, if you're going in with the idea that that's just what happens all day, every day with every suburb in Australia, that's where you can get yourself into trouble. And back at the back end of 2025, we saw APRA entering the chat for the first time in the last little while. And I think we're around about 2% under the point where they introduced the interest-only caps for banks. Obviously, they're talking about the income to asset multiples. They want only 20% of their portfolio to be over, I think, 5 or 6 times income. How are you seeing that APRA stuff playing out? And can you also sort of overlay that across the difference between the big four, for example, and the third tiers who don't necessarily have to play as strictly by APRA's rules?
Yeah, look, I think it's an interesting one, because speaking with other colleagues who run brokerages as well, we don't have a lot of clients who get up to that level.
Mm-hmm.
And I think it's an important thing to put into the market to prevent people who are just putting in, loads of applications for clients. And we did see this. Feedback I was getting from some BDMs at different banks who, regarding the trust stuff, was like people were having just individuals with different trust. Maybe might have had 7 or 8 applications going in the week before those changes came in. So
Wow.
people were exploiting this, for personal gain all along the way. There were buyers agents who wanted to buy 10 and make, as much money as they could, and brokers who wanted to write as many loans like that as they could as well. Now, was it the best thing for those individuals? Maybe, but maybe not as well. So I think that APRA sort of getting involved is good to prevent that maybe top 1% of exploiters who are really getting after it. As far as the way that we do business at Runestone, and a lot of my friends who run other brokerages do it, for most people, it's not the right thing to get up to that level anyway. So there would be, I might have a handful of people who would be above 6 on my book currently. And I've got a lot of aggressive investors. So I don't think it's going to be particularly impactful for people who are already doing the right thing by their clients.
Yeah. So when we look at the third tiers, what are some of the ways that they are different to the banks, over and above the fact that they will swap risk for an increase in interest rate to a certain point? But obviously, they also have their own internal limits, and they're not just going to give you exactly what you want, because you really want that 7th or 8th investment property on your 80 grand a year single salary.
Mm-hmm. Yeah, quite right. Look, they do it in a number of different ways, and I always quantify serviceability as how much money do you have coming in versus how much money do you have going out. Now, there's a tad more nuance to it, otherwise I wouldn't have a job, but that's more or less how it works. So throughout that process, banks and third-tier lenders alike will apply buffers everywhere. So I spoke about the 3% buffer that your big banks will put on. Third-tier lenders, for the most part, will use more like a 1% buffer. Right. So they just take a little bit less out of the kitty, which allows you to then bolster up your borrowing capacity as well. And as I said, they don't do that for free. They charge you more on the rate for that. The expenses might be a little bit lower as well in terms of what they let you get away with, and they might haircut your rental income a little bit less as well. So there's always little parts that make it conservative. And the third-tier lenders are just slightly less conservative and make slightly more money.
Yeah. And so to finish us off with some takeaways in terms of your strategy and what you've seen working. I mean, you mentioned that we've talked about the AVM strategies, talked about leaning into third-tier lenders, but your basic strategy of maxing yourself out as an individual with the big four, then maybe going to the third tiers. What else is there in and around the trust stuff? Because obviously trusts do have a part to play. They're not just a unlimited borrowing capacity vehicle. They're asset protection and those sorts of things. And what we do know about trusts is that if you can have that in a positive position, you can essentially tie a bow around it, start a new one, and it sort of ceases to exist in some mythical way. But what else do we need to know if we are aggressively trying to build our portfolio in 2026?
Yeah, look, I think there is still a place for trusts in but that place is when an accountant tells you it's the right thing for you. And I think if anybody else is telling you, go and see your accountant, because they're really the one who sort of has to give you that advice. I've used trusts in my own borrowing journey as well. And most recently I bought a place in Melbourne end of last year. And I thought it would be interesting just to weigh up the opportunity cost of either buying in my individual name or buying in a trust. And the differences are massive, mainly due to negative gearing in your individual name not being able to apply in the trust, right?
Yep.
So if you're borrowing, particularly if you're leveraging the equity from another asset to borrow for this one, the difference in your sort of negative gearing position, it was going to be, after everything, it was probably going to be a difference of a tax refund of about 15 to 20 grand, right? Not coming back. And then plus you've got tax returns, each year for the trust, asset registration fees, the setup, which is about 3 grand for the trust and the corporate trustee company. So, very big. This is a lot of money when you're talking about a $1 million asset. So yeah, it's one of those things where you have to weigh it up for yourself. It can be done in a way that's really beneficial for you, but just note that these sort of, and I say this to anybody who's used a trust in the last couple of years with me, is there's no guarantee these policies will be available. They can be pulled, and we're seeing them being pulled across the board. So to answer your question, the sort of best way to build a portfolio out today is to firstly figure out with you and your partner or yourself, whatever it is, what is your end goal? Because just buying willy-nilly, you're going to end up in the wrong place. What's your end goal? Is it to build out a big portfolio to eventually buy the owner-occupier? Do you want to Rentvest forever? Do you want to eventually get to commercial? Whatever it is, put that down and then go and speak with a brilliant buyer's agent, a great broker, build a really good, strong team around you and let them tell you, hey, here's what I recommend for being able to get there. And combine that with your own research and then go and execute on it. But yeah, there's never going to be that sort of one thing that gets you the promised land. It's hard work and doing a lot of research.
It's funny, isn't it? Because I feel like there's a lot of pressure for me as a podcast host to get somebody that says that here's that one thing, that magic shortcut that we're looking for. But it's so amazing how many people bring it back to, well, it's actually fairly simple, and it all really starts with strategy. Forget all of the noise of the hot spots and the trusts and the structuring and the diversification and the yield and capital growth. It's like, what are you actually trying to achieve as a starting point?
That's right. Yeah. And if you don't know that, well, then you're going to get very lost along the way. And halfway through, you're going to think, well, I've got $2 or $3 million worth of debt, but I don't really know where I'm going here. That's not a great place to be.
It's certainly not. Well, thank you for sharing that cautionary tale for us, and some of those juicy little things that are definitely worth investigating. Obviously, if people are high net worth income and they're struggling to think about whether to actually put all their eggs in that one basket, you've been speaker one for the negative on that one, Patrick. Thank you very much for sharing all of that gold today.
My pleasure. Thanks for having me on.
Cheers.